This is a Brooklyn-bound 2 train. The next stop is
Wall Street.
Stand clear of the closing doors, please.
Welcome back, everyone. This is Not Your Advisor with NYU Grad on Wednesday, September 25th. Where is the Batman? Gotham City needs the Batman. Who will turn on the bat signal? So today, I want to give a quick reminder warning about Tuesday's session. So the Bloomberg 500 tracks the S&P 500. The way that they do weighting is a little bit different. It's more automated versus the manual process for the S&P 500. But the Bloomberg 500, as a proxy to the S&P 500, 93% of its gain on Tuesday was attributable to NVIDIA's gain. That is not healthy. So with that warning, let's go into today's session. I have a lot to cover. My guess is that today's episode will be the full runtime of 15 minutes for the free podcast listeners. So another bit of warning, that's the theme of today's podcast. For those that are in Florida or in the Gulf, I want you all to be safe and good luck with Hurricane Helene or Helena, however they pronounce this. Apparently, over the evening session into tomorrow, the winds and the impacts will be at max strength. Florida is bracing for up to 120 mile per hour winds and a 15-foot storm surge. So everyone in Florida will be impacted by the storm surge, in addition to the high winds and rains. So definitely be safe, protect your families, and try to stay out of harm's way. I'll have a screenshot of NVIDIA's record impact on yesterday's move for the Bloomberg 500 index in the show notes for free members. You can take a look at that. You'll see that the index move percentage is 93%. That basically means if all else were flat, NVIDIA would have contributed 93% of the Bloomberg 500 gains, which is a proxy on the S&P 500. Another warning, I'm going to read as eloquently as possible what Bill Cara, my mentor, published on his website this morning. So here we go. And I want to reiterate, Bill Cara has been a professional elite trader and investor for as long as I've been basically alive. He's been a published author. You can look him up on BillCara community.com. I'm sorry, just BillCara.com, and you'll see all of his background. He was at Canaccord, one of the largest brokerages in Canada, and he has a well of knowledge that I find has been unsurpassed in my journey through Wall Street and networking. But I'm going to quote him. So he said this morning, Warren Buffett, by the way, this will be all in the show notes. You can read it, so you don't have to listen to me reading it. But for those that are on the radio, listening in the car, on the plane, here we go. Quote, Warren Buffett's $300 billion cash bet, preparing for a global financial reckoning. As of August 15th, Warren Buffett's Berkshire Hathaway held a staggering 42.75% of its total market and private investments value in cash, amounting to nearly $300 billion. This growing cash pile strongly suggests Buffett is bracing for a major market downturn. Investors should note what he's selling, such as Apple and Bank of America shares, as these may be holdings he considers most vulnerable in an upcoming crash. Buffett is well aware of the mounting global financial risks, particularly the unsustainable government debt levels across the world. Deficit spending continues unchecked, regardless of the political party in power. The total debt and accruing interest on this debt is now a ticking time bomb that today's economic engines are ill-equipped to defuse. Central banks have recently begun slashing interest rates in response to deteriorating financial conditions. A few weeks ago, several countries cut their policy rates, and the price of gold surged. When the Federal Reserve followed with a 50 basis point rate cut, it further fueled gold's upward trajectory. This precious metal, being debt-free, stands out as a reliable store of value during times of crisis. Gold is poised to soar even higher as more central banks lower their rates. I also warned about the dangers of Wall Street's recent wave of IPOs, secondary offerings, and share buybacks. The banking cartel, what I call Humongous Bank and Broker, or HB&B, is draining wealth from hardworking people to pad the pockets of financial engineers. Much like 2007, the era of credit expansion is coming to an end. Deflation is now the real concern. Back then I warned, books will be written. I'm saying that again today. Adding to the current crisis is the fact that the COVID-19 pandemic has devastated commercial real estate. People avoided office spaces, leading to massive losses for banks and their investor friends who have made risky investments in this sector. As the Fed continues to cut rates later this year and next to prop up these failing assets, it's clear that the central bank is working to save the banking cartel, not the public. Investors have been misled for years into believing that rate cuts are a green light to buy stocks. The opposite is true. At the very least, we should shift from financial assets to hard money like precious metals. Physical gold, in particular, remains free of debt and is outside the grasp of humongous bank and brokers' financial manipulation through futures and ETFs. It will endure, as will the miners who produce it. I made a similar call in 2006 when I warned my readers about the real estate bubble. I pointed to CNBC's nationwide real estate tour as a sign that the banking cartel was pulling its investments ahead of the crash. My prediction earned me a feature in the Wall Street Journal's new Competing Viewpoints series. The Wall Street Journal editors told me they couldn't find any financially respected Americans willing to make the same call. I did. For those who doubt my certainty about the end of the equity bull market that began in 2009, look no further than China. This week, the People's Bank of China cut its reserve requirement for banks and offered mortgage relief. Its 10-year bond yield hit a historic low of 2%, and the PBOC is about to inject 500 billion yuan, around 71 billion US dollars, into the stock market. These extreme measures signal the looming deflationary crisis. Now is the time to follow Buffett's lead. He's selling equities to build cash reserves, preparing to buy strong post-crash. The public should consider doing the same, particularly by increasing their exposure to precious metals, an asset class held in high esteem for millennia. Central banks in China and India are buying gold in vast quantities, and soon it will be on everyone's radar as the global economy shifts into a new phase. Wrapping up, Warren Buffett does not hold almost $300 billion in cash for no reason. As governments face insurmountable debt and deflation looms, gold and other hard assets become central banks' and everyday investors go to safe havens. Follow the signs, prepare for the downturn, and remember that sometimes the best investment is the one you don't make until after the storm. End quote, Bill Cara. Now, if you missed any of that, it's all available on the show notes. I will link to Bill Cara's website. I agree with everything that Bill Cara is saying here. I think when you take a look at the macro in the next decade, precious metals will do very well, as it has been in the last 50 years. If you price the S&P in the price of gold, gold is outperformed in the long term. The only wrinkle here, and again, this is my personal observation, when you take a look at the 2007-2008 Great Financial Crisis, when stock prices started to fall, the first initial wave of selling, like the first 3 to 6 months, gold, precious metals actually fell with stocks. Gold recovered before stocks, but in that small window where it was panic selling, where it was like, just get me out, when the NASDAQ was down like 70%, when everyone was selling. You remember, if you were old enough, you remember the panic. In that window, gold, silver, miners all fell as well. They just fell less. And in that time, TLT and bonds rose for that short window. And then once that panic selling was over, bonds sold off. And then that's when gold reversed first higher and started to just continue higher when people started to realize what was going on. So I agree with everything that Bill is saying. I learned a lot of what I know from Bill, and he knows better than I, but I'm just looking at the micro adjustment of like the first few months. And I don't know when this will start. I don't know if it will happen this year, next year, 2028. No one knows. But what I'm saying is when that sell-off finally starts and people start panicking and your text message thread is blowing up because everyone's like, oh my God, what do I do? You may see gold fall as well in that short panic period. Keep an eye on it because this time can be completely different, right? Now we have the whole, because in 2007, 2008, Bitcoin wasn't as widely talked about back then, right? So now we have to think about how Bitcoin is going to react. So the other thing that I think about is if you were an adult making income in the Great Financial Crisis, you now have that muscle memory of that crash. So what I'm saying is that not only are stock prices and charts fractal, and I'm not going to get into the weeds of fractals, but emotions are fractal as well, because all the market is our emotions in the marketplace. So my point is that because there is a group of us that participated in the Great Financial Crisis, that participated in the COVID lockdowns, we are more, conditioned for flight. People either fight or flight, right? Those are the two emotions that are just innate from our hunter-gathering days. So the next time prices really start to go, just look back a few weeks ago when the whole yen carry trade headline started to spike. Remember that? Prices fell, like in Japan, 25% overnight. We are now really conditioned for flight. And everyone is long the same 7 stocks. So be very, very careful. I'm going back into yesterday's action. NVDA accounted for 93% of the entire day's gain in the S&P 500. One stock. So that is kind of the summary version and recital of what Bill Cara spoke about today. I'm going to, you'll have to bear with me, free and premium subscribers. I need to pat myself here and plug myself. So I wanted to give two examples why free members should be upgrading to premium. Here's a preview of two examples that are very specific. And if you are a premium subscriber and I am lying or I'm BSing, comment in the comments so that free members can see I was wrong or I'm lying or I'm misleading. But I'm sharing with all the free listeners and free subscribers right now. I said that the time, even during the summer sell-off, the time is now transitioning to be in safety, to be defensive, not YOLO longing into NVIDIA as everyone chases the stock split. And at the time, I started to share a best defended list, a list of stocks that are best defended, that typically rise when stocks and the market sell off, and they go down less or they go up. Let me rephrase. When the stocks are crashing, they go down less or they go up. And when the whole general market rises, they also participate for the most part or just stay even. So this first chart is anonymized because I don't want to give everything away for free. It is a chart of one of those best defended. I've indicated as a line that goes north to south when I started to recommend it. And I trade auction market principles and balance areas. And I noticed that this was getting close to breaking out. I alerted everyone. Not everyone took advantage of this. Some did, but keep in mind, this is when everyone was chasing NVIDIA and the YOLO stocks. This safety stock has gone up 33% since I recommended it. They pay a dividend. They go up or go down less when the entire market sells off. So that's one example. Another one is AppLovin. I sent out the alert when this was going to break out potentially earlier in 2024. AppLovin is up 280% since the alert went out to my premium subscribers in February of 2024, just 8 months ago. And I also keep track of where the pricing is and let people know potential risk areas, potential areas to get out. This is never advice. This is just my eyes and my observations. So just two examples of why you should upgrade to premium. It's $34 a month. I mean, we're talking the price of a pizza pie at Le Industry in New York. So I don't think I'm asking for a lot in return for the value I provide. But consider it. I think I can help you at bare minimum learn more so that you can see the markets in a way that Wall Street does not want you to see it, and for you to have the ability to grade your financial advisor's homework. So I'll get off my soapbox there. Before I get into peeling the onion a little bit further, just as a exercise of Paul, and speaking of cartels that Bill Cara talks about, I'm just going to post images, screenshots of all the corruption that's being alleged and investigated in New York City. The latest one is the New York City Sheriff of NYPD is alleged, not convicted or found guilty, but alleged that he and his office were stealing money while they were closing down illegal weed shops in New York City. I mean, if this is true, this does not get, it can get worse, yeah, sure, but it seems like every week there's just more dirt coming out of the halls of New York City Hall. And I'm wondering, the FBI is investigating this. I'm curious, I'm wondering if in your city, if you are also seeing this type of corruption coming from your local governments. It's just off the charts. I feel like these headlines are like straight out of a comic book. I'm just waiting for the headline of the Joker running up Broadway. It's just insane. So that was a quick summary of macro of the day. I do want to go through what stuck out to me today. Wow, I did not even cover breath. So I apologize for going on this tangent, but I felt it was important to cover this because I think right now it's much more important to focus on the forest versus the trees. But let's go into the trees. Breath, we had 677 new highs, 174 new lows on the NYSE. On the NASDAQ, we have 50 highs and 68 new lows. 24% of stocks were advancing versus 73% declining. 33% of stocks were below their 50-day, as well as 33% below their 200-day. What stuck out to me on the data perspective is that the 10-year yield has done nothing but go up since the September 18th FOMC 50 basis point cut news. The yield curve steepening is getting steeper, whatever. I invented a word. So for the premium members, I will post a chart of the 10-year, 2-year curve steepening, overlaid with the S&P 500. So take a look at that, as well as a chart of the 10-year yield. What was strong? So I have a new list that I'm going off of here. I'm going to go through the NASDAQ 100, NASDAQ, and the S&P 500, what was strong, and then what was weak. So on the NASDAQ 100, we had Micron up 12%, Lam Research up 4.4%, Constellation Energy up 3.8%, Intel 3.55%, Advanced Micro Devices 3.26%, Applied Materials 2.91%, NVDA 2.98%, ARM Holdings 3.08%. Wow, so semiconductors held the markets up today. The S&P 500, there were quite a bit green, and I'll cover what was weak in a second. Micron, and some of these names you'll see as duplicative because they're in both. This is how they're double dipping. Micron in the S&P 500 up 12%, as I mentioned. Vistra Energy up 6.4%. Hewlett Packard up 5.3%. Lam Research again 4.4% in the S&P. Constellation Energy up 3.8%. Intel 3.59%. Man, this is all duplicate. So again, I don't think I'm going to do this list again because this is total BS, and you can see it's the same names in the S&P and the NASDAQ 100 that are green. This is how they're doing this. What was weak? Amgen down 5.4%. This is on the NASDAQ 100. CoStar Group down 3.4%. Dexcom down 3.1%. Charter Communications down 2.7%. Biogen down 2.63%. On the S&P 500, Global Payments Inc. down 6.49%. Amgen down 5.49%. Hey, there's Amgen again. They're both in the S&P and the NASDAQ 100. Okay. General Motors, 4.8%. Southwest Airlines, 4.5%. Archer Daniels Midland down 4.2%. Tyson Foods down 4.2%. Carnival Cruise Line down 3.7%. Norwegian, 3.6%. Halliburton, 3.6%. ServiceNow, 3.5%. Let's see. Walgreens, Boots Alliance down 3.1%. Yeah, so that was what was strong and weak today. Free members, continue to watch the macro. Don't focus too much on the micro. We are in for a deceptive new high regime. We got a new high this morning. We might get another new high tomorrow or Friday. But I'm telling you now, They are selling. The sell side is selling. And they're using all of the passive investing channels to sell into. So be on your toes, be very careful. Talk to your financial advisor. Read or send what Bill Cara wrote. What do your financial advisors say? Things that I usually hear are, if you sell now, you're going to miss the greatest bull market or the greatest rally. The biggest rallies happen on bear markets or some version of that. Or they just won't return your calls. But let me know. I will see you all after the Thursday session. Premium members, please stay on. I have a ton of charts to walk through with you today. That's my train.
Stand clear of the closing doors, please.